Good evening, everyone. Welcome to Admiral Markets. My name is Chris. Jontala is today with us as well when we take a look together at how to exit trades as a true Forex master. So looking forward to this webinar. Before we start with our content that we would like to present, please be aware of these disclaimers. There it is. First of all, the fact that this webinar is intended for a global audience and therefore may not be suitable for everyone. To find out if it is and other details, please visit admiralmarketsglobal.com, select your country of residence, and contact the appropriate entity. That same path can be used to request a copy of the risk disclaimer, which states that trading for exchange is considered high risk and may not be suitable for all traders and investors. Therefore, please seek the advice of an independent financial advisor for more information on that. This webinar is not advice and is for informational and educational purposes only. And by continuing watching this webinar, you agree with all the angles of this risk disclaimer. Alrighty, thank you for your attention. This is once again hosted by Admiral Markets, and hope you have the time to take a peek at all the good stuff at Admirals, such as analysis and trading platform. So do that, please, but preferably after this webinar. First, we're going to take a look at why exits are important, then what tools I use, and other concepts for timing of exits. And then Jontala is going to take over and show his part of the of today's presentation. So why are exits so important? Well, obviously because that's the end result we get for our trade. The entry and exit, of course, is the difference between those is what we get. And ultimately the exit is something that determines whether it's a profit or loss. The exit is, of course, a very important factor as well, I'm not saying, but ultimately whether the exit is lower or is better or worse than the entry is the ultimate measuring point, so obviously it's important. Traders somehow do focus a lot on entries, but not so much on exits. Quite interesting why. I don't know if you have any ideas about that. If you do, let me know. I would be quite interested in it. I'm not sure, actually. I guess maybe because it's easier to do, or I'm not 100% sure, actually. Right now, it's maybe not so relevant. But it is very interesting that a lot of work and focus is done on entries, testing, strategies, but unfortunately, entries are max half of the job, but probably even less. How much they are exactly worth is always a debate, but many basically traders say it's 20% of the story, and exits, I don't know, exits 60 or 50, and then 30% perhaps trade management. It doesn't really matter how much the percentage is exactly. The point is that entries are often over important and exits less. The exception would be if you're not using leverage, because then of course the timing is not as important. If you use your savings and you say, okay, I think my savings in euros is going to have a hard beating the next year, and I want to make sure that I'm not running that much risk, and someone turns in half for dollars, well then, you know, if you short it at, if you exchange it at 138 or 135, at that time, it really doesn't matter that much. Of course, trading with leverage makes it a lot different. So anyhow, the exit basically, it's funny how entries alone could be great. In fact, a beginning trader could be lucky and get a great entry, but unfortunately, with the bad exit, it's worthless. Interesting how a trader that is really using, let's say, not a set and forget strategy, but more an active trade management could have a horrible entry, but still exit pretty good. And someone who's really actively trading a lower time frame could basically exit at a spot that their losses are very small or around break even, but they do let those few trades go for runners. So the exit can basically save a horrible entry, limit the losses, but allow occasional good wins. Here's some examples of different entries with various outcomes. The first one you can see entry, and if one gets nervous with the basically pullback after that, right, the exit could be at a loss, but the price still continues. So if we look at all these potential entries and exits that you just could find as we go and look at this combination of parabolic and the Tenkin and Kiyun lines from the Ichimoku indicator, you can naturally see that there could be a lot of exits upon the pullbacks to the Tenkin lines and to the Kiyun lines, but that they would be pretty at a disadvantage compared to traders that have been more patient waiting for their targets. Here you can see that the market is just in general obviously divided into two phases with correction and impulse. The basic understanding is that impulse, of course, is price movement where price goes fast to our target, and correction is a lot of choppiness. And with impulse, of course, we can expect price to go to our targets quicker. And in that regard, we have and can have more patience with our exits. So identifying the difference between those two zones is very important in helping determining the potential of an exit. In choppy zones, we might be happy with a break-even, for instance. In a momentum zone, we might be more patient and wait for momentum to continue. And I'll tell you a technique how to use that later on in this webinar. So looking at the Tenkin lines, for instance, the angle, if there is an angle, could help as well. So methods for exiting trades, we have automated, set and forget until predetermined element, and then an active trade management. The most, let's say, precise is point 4 because it allows a trader to be actively analyzing each and every new set of information. By doing that, we can allow a lot of flexibility and basically find one of the best exits probably possible. But there are also disadvantages of that precision. The psychology part is more difficult. When trading that actively, the trade management, and trying to determine an exit as good as we get with each piece of new information, because every time we see a candlestick, of course, close, we have new information available, we do run the risk of getting nervous, getting emotional, letting psychology kind of mess in the trade, and we might take suboptimal decisions because we just have rosy glasses on and we just don't see at that moment we just get kind of too much impacted by one candle, too much impacted by a single piece of information, and do something, let's say, not optimal, maybe a bit foolish. And in retrospect, when we look back at the charts with a calm state of mind the day after and we evaluate the setup and the trade management and think, why did I do that? I don't know why I did that. There was no reason to do that. And that's emotions and psychology coming in. So yes, active trade management allows us to be the most precise and probably allows for the best exit, but is the most difficult because it must require a very determined control of our emotions and psychology, and we need pretty good up to excellent patience and discipline. Automated, instead of forget, is kind of the opposite, where we have the advantage that we don't let ourselves maybe be impacted and influenced by emotions as much, because it's anyhow, we don't have to even look at it. It's a set and forget, which means we can really enter the market and we just walk away. We have a stop loss and TP in the market, and we don't need to know anything more. We don't do any active trade management, so it's going to be a win or loss, and that's it. So that means that if we don't have to look at the charts, there will be no emotions connected to it. Now, the disadvantage, of course, is that the exit is going to be less precise because we choose to ignore the new information available to us every time we see new candlesticks. We take a decision to enter the market at point A. But after that, a whole bunch of new information is coming at us regularly. But by setting and forgetting, we say, okay, I don't care about that. Whatever it is, I'll ignore it. So that, of course, is, in a way, leaving a certain opportunity on the table and not using that. But, as I said, the advantage is that we are staying in whatever happens. So we're not exiting too prematurely. If there's a choppy zone or that shouldn't scare us, and we do get scared, we kind of exit too early, and what happens is that we take plus 10 pips, the trade finally breaks, it hits our profit target of plus 50 pips, and we hit our head and say, oh, I was right all along. I just should have been more patient, then we get mad at ourselves. So those are the two balances. With active trade management, we have to walk that fine line of finding the moment of intervention and exiting, but not prematurely exiting too early. That takes a lot of experience, so it's more difficult. Set and forget is easier, but not as optimal maybe in exiting. Point 3 is an interesting balance where you say, okay, I will do some active management, but I first want to see price get up into a certain profit territory, or I want to see it actually move against my position halfway before I start thinking about it. These are kind of soft targets. First it has to do this, then I will do something. I will move the stop loss. I will think about setting a TP. It's an interesting mix because it kind of gives some time and space to a trade to develop before any decision is made, but when that time has come, then you do kind of intervene in the market. So it kind of gives that halfway balance. Often enough, too early, making decisions on that too early in the game might be actually the most disadvantageous. The problem just is, here's the slide. It's a simple Tenkin and Kiun. And although I use myself the EMA 21 band, which is a high, low, and close, I must say that the Tenkin and Kiun for me is a very close second placed indicator for the trend, because I like the fact that it's sometimes just flat. There's no momentum. So if there is an angle, there is really momentum. And moving average is a bit difficult to see if there's an angle or not. There's always some kind of angle. It just depends how much, I guess. Alrighty. Well, I guess I already talked about the pros and cons here, so I was a bit too quick on that. But basically, one thing to add about the active trade management is that it's more intensive. We got more options, basically, but tough for our psychology. So here's a different way of looking at the charts, fibs and moving averages. And basically, you can see that, for instance, an entry here at the confluence of the 61.8 and the minus 61.8 targets, the fib target and fib retracement, a great entry. But if you don't have that patience to wait for the exit here at the minus 272 target, right, you're leaving some profit on the table. So it's very important to exit at the right spot. So I'm going to talk about various tools now for exiting. Static, dynamic, and a mix. First of all, static. Static tools are support or resistance, fractals, tops and bottom, and Fibonacci pivot points. They basically do not move. They're just always will be a horizontal level. And there's not going to be any movement in that. If there's a new candlestick pattern or a new candle, support and resistance is still at the same level, the horizontal ones. So let's take a look at that. Fractals here, for instance, if you're using that for exits, right? So when price is falling here and you use the fractals, that means you're trill stopping all these fractals and getting out when price goes against those fractals. And they can be very useful for finding the exit when you have a bit of patience for a trade to develop. Sometimes it takes time before a fractal appears on the chart, and you got to need a bit of patience there. Sometimes fractals in a consolidation appear too soon. So with my advice with Fractals is that it's okay, but the trade has to be, it's best if the trade is up in a bit of profit. And then it's okay to use to do the Fractals as a trading stop. If price is really far from a fractal, it could be even wise to look for a TP, because then you don't want to leave too much profit on the table, because if the fractal is really far from the price, using it as a trail stop is still good, but do you really want to give up that much profit? Do you want to see price go against your position that much before you exit? So fractals are good, but they pose two problems: an exit too early and an exit too late when the fractal is really far away from price. If you can avoid if you can avoid occasionally these problems, they are, I think, pretty useful. But what I do is not too early using them. All right, so let's take a look at the others. Support and resistance. Obviously, key tops and bottoms are important as well. But for me, what I like a lot is highs and lows of bigger time frame candles. So if I'm entering on a 15-minute chart, I mean a time frame higher, like the hourly. If I'm entering on the hourly, the 4-hour. If I'm entering on the 4-hour, I could even use the 4-hour chart for the 4-hour entries, by the way. What I mean with that candle highs and lows is not every particular candle high or low. Let's say we're in an uptrend. For instance, the dollar-yen. Let me see if I have an example here. I don't think so. Let me use a live chart here for a second, okay? 1 second. Let me go to dollar-yen chart. There it is. Sorry, I'm not showing it to you actually. Here it is. Let me make the chart clean and show you a live example of what I was discussing actually in the trading room on Tuesday. I said this breakout trade here of this trend line, I'm taking that breakout trade and I'm looking for a candle. Well, let's not talk about the entry, but I was looking for a strong candle with the close near the high and with at least half or more of the body above the trend line, which this 4-hour candle qualifies. So I took the entry at 119, I think it was 26. The stop loss I put below the candle low here. These are green lines, which makes it a bit annoying, but let me take this one away for a second. Okay, we know that it was a trend line break. I said I'm looking to trail stop the candle lows. Right. So first of all, you can always use that. You can always use the candle lows, and with that, in that regard, the exit would have been here at 120 something. So it would have been a 75 pip profit, 50 risk. Now, in my case, I actually had a TP at 120.40 because of bigger time frame analysis based on the daily chart. I expected the price to have a headache with 120.75. I also, when adding a fib to this swing high, swing low, which was the most impulsive part, saw a minus 618 target at 120.48. So for me, it was priority to exit before 120.70, 120.80, but also preferably before the minus 68. So I went for 120.40. That was this Tuesday, I said that. So that was a pretty good exit because that was exactly the turning spot, 8 pips higher, and indeed right at the minus 618 a turn and downside. So it was a good combination of, I think, an exit. First of all, a TP aimed at a good spot. Thank you, Justines. I was also happy with that. Good 114 pips. A TP, but also a trail stop just in case, because we said at that point, like, okay, this could the impulse could be good here, but as soon as the impulse is gone, it could really start falling like a brick, and we don't want to get caught in a bearish impulse that turns on us and see our positive pips vanish and eventually go into negative territory. And that's, to be honest, that's exactly what happened, because it started to really fall. And if you're still in the long, you're kind of hoping that the market turns around here, which probably will not happen. Well, eventually it will, but probably way too late. So you're kind of out of the game here. You had a good trade, it was up in profit, but got squeezed. So that's why the breakout trade, I was emphasizing, the breakout trade is good, but you want to actively manage it. You want to be on top of the game here, because the momentum can last for a while, but it could be over before you know it, and then you want to get out. Luckily, I got out at the best spot, which was the TP, but the trail would not have been bad. It would have been 120 instead of 120.40, around 120 instead of 120.40, so that's not too bad. Other times, not specifically in this case, but in other times, I look for bigger breakout candles. I use the lows and highs of that. What I mean with that is that I wouldn't use every single 4-hour candle for a trail stop. Smaller candles, indecision candles, I just ignore. What I'm looking for is a clear directional candle, like this one, or like this one. Only then would I use the low for that candle. And I use that tactic if I expect the upside to have more space. Let's say the situation would have been different, and I'm expecting more upside. And I'm expecting this to run up to go really far. In that case, I don't want to overcrowd kind of my trade with a trail stop that's too tight. And then I'm looking for sizable candles that show that that low will probably not be broken, like this candle here. Let's say I take the long. I survive. This is a bull flag, and then I see this breakout. This is a candle here that has a strong directional guidance. So I could move that trail stop loss below that candle. But I wouldn't move it perhaps under smaller candles like these or these, because those are indecision candles. So that's another way of doing it. Kind of filtering out, using the lows or highs of any candle, but let's say in this case, in this example, 4-hour candles as trail stops, but then kind of choosing which ones to use. All right, so those are that is another example. The difference, once again, between using every 4-hour candle and only some of them is like how much space do we really see. And in the case of the dollar yen upside, I wanted to use every one of them. So that was a live example. Anyhow, these are, once again, just to refresh your memory, these are examples of static exiting methods. When price does not move, I mean, it's a level that doesn't move, basically, right? Tops of Fibonacci pivot points. Here are, I'm being afraid I'm running out of time here, so I'll move on. But anytime you use levels that just don't move, you're basically using static ones. Now, the dynamic ones are actually tools that move along with price. That trend line is kind of a semi-example because it moves at a fixed rate depending on the angle. Moving averages, of course, surely are impacted Ichimoku as well. The advantage of that is that they are flexible and therefore always relevant. Static, eventually, they lose their relevance because price is so far away from them that it's not going to get there anymore. The dynamic always have a relevance because if you use parabolic, if you use moving averages, they're always kind of at a certain relevant distance to price. So I like, or Ichimoku as well, of course. I like these tools as well to give an idea about support and resistance, and hence also exits with the trail stop loss. What I like to do is combine fractals with the moving averages. Fractals that are below the moving averages in the downtrend, for instance, are fractals that are vulnerable to be broken. Fractals that are touching the moving averages are often more solid, right? So that's one way of looking at it. For instance, this fractal right in here, you can see that although the exit there would not be bad if you're in the short, by the way, I mean, the profit is profit, that to a certain degree, the next fractal, which is touching the moving average, would allow for the trader to catch a bit more, right? Let's see. Which example do I show here? This is dollar CAD, a 15-minute chart, and you can see that, for instance, this very impulsive move up with a very strong AO. You see a bull flag after that. Moving that trail stop too soon below this consolidation is a bit of a pity, especially if you see that strong momentum. The chances of a continuation of some momentum is high. So if you're overcrowding the trail stop loss here, the exit is most likely going to be too soon. Okay, I have tons of examples, but it wouldn't be enough time. Last but not least, the time factor. time factor is very interesting, I think, specifically the number of candles. It's something that I use for my own trading a lot. Let me use a live example on the 1-minute chart. For those that were in the webinar yesterday, by any chance, know what I'm going to show you here. Basically, was looking for a short on the 1-minute chart, just scalping as an example here of a fib trade where I took an entry here upon this small shooting star at the resistance spot of the fib and mini double top, very mini double top short right there. Trade was going our way. And look at the momentum, every candle, almost every candle, lower low, lower low. But then we got a some sizable impulse here. And within 5 to 6 candles, we didn't break this low. So at that point, I already said, okay, I don't think this is going to break. And we're going to see probably some consolidation. And indeed, price moved up to the 78.6 fib, eventually up to the 86 fib, and to the 113.25 level that one of our traders was looking for. And then it did fall down back to the bottom of that wedge on the higher time frame, which was 112.75 for a 50 pip fall, which is small on the 1 hour chart, but sizable on this time frame, of course. And the idea, of course, of 5 to 6 candles not breaking in our direction is not golden. It's not perfect. But it does give an idea of, okay, how much of patience can I have? And if it's within 5 to 6, the patience can be certainly on the higher side. If it's more than 5 to 6, the patience could be on the lower side. I don't want to say it's that simple and only that is what I use, but I do like to use it. I think many times it is very precise, not always, but I do think it's a very good element of adding. And most of the time, you do see, these runs. Let me maybe go to the 5-minute chart here. Move pretty fast. Let's take a look at here. You can see this was the big consolidation I was in. But here, for instance, the run here, right, of what is it? 20 pips. It's not a lot, but it's just to give you a point. Lower lows, lower highs, right? Then you get a consolidation. You get again a run. So basically, if there is an impulse, my point is basically if there is an impulse, here's a good example. When there is an impulse, it's usually quick. Every candle continues into the direction of the trade, and most of the time, the trade doesn't pause more than 5 to 6 candles. Look at this starting candle, and then look where it ends. All of that movement, no significant pause of more than 5 to 6 candles. When we do get a 5 to 6 candle pause, it's somewhere down here, 2, 3, 2, 4, 5, 6th candle. 6th candle is still bearish, so I would still be cautious. Then there's still a 5. If the 5th or 6th is bearish, there's still a chance of continuation. Ultimately, this candle does break the last low by about a pip. Then you get again 2, 4, 6 candles, and here we get double bottom and upside. So that is indeed where the impulse is over. So it is not everything, but it gives a kind of an idea. Here, start of impulse. Here is a bit of a pullback. 3rd, 4th, 5th candle though is bearish. 6th candle is bearish, so watch out. It can still continue. It does continue. Boom. So basically, you do get the fall here of 50 pips within all these candles, and then the 5th candle here after this bounce 1, 2, 3, 4, 5 is bullish. You get the hook back, but it can't break this bottom, and you get the consolidation. Here too, the impulse, a continuous fall until you get a moment where the 5th candle doesn't break, correction. So I don't think it does a bad job. I think it's, for me, it's something that is a very nice extra tool with exits. Where's the best moment to get out? To be honest, it's going to be interesting to see how price reacts to this trend line, in my opinion. and how this candlestick, this 4-hour candlestick, reacts to it. I mean, if you get a big wick here, I think the bulls are not much in control as yet. If this becomes bigger or closes very bullish, then maybe price is about to break above 114.25. At this moment is still a question mark. I guess for me, I'm very curious how this 4-hour candle will close. Last but not least, price action, and I guess I'll leave that up to Nenad. I think he'll be talking about that. So, but obviously candlesticks patterns, chart patterns, and divergence are certainly things that make a lot of sense when analyzing exits. So, with that said, I will hand it over to Tarantula. Let me pass over the charts here.
Thank you, Chris. Lovely presentation. Yeah. Now we will continue, and I will show you technical and other things which you can do to exit your trades at the optimal price. So here we go. First we will talk about ways to determine best take profit zones, then technical exits, trailing stop, additional approaches, and especially these two approaches, MAE and MFE. So these are the things which you should definitely consider to upgrade your knowledge. And after this webinar, because this webinar will introduce you to MAE, MFE, you definitely should consider this in your future trade management analysis. Okay. So the first thing to say is that how to determine best TP zones is usually very dependable of the system or method you are trading. For me, I might have one approach. For you, you might have another approach. So that is always up to you, up to the system which you are trading, up to the method. You just cannot trade it like a robot, because sometimes, even though your system and your analysis is good, sometimes there are still some unexpected things which might happen during the day and basically make you slightly bit disappointed for the potential trade. The situation which we had today on Australian dollar, to be honest, for me that was pretty much profitable. We had plus 20 pips on first rejection, plus 30 pips, and plus 22 pips on second rejection. But I was expecting that it will drop maybe 50, 60 or 100 pips. The thing is, why it didn't drop 50, 60 or 100 pips is definitely because of dollar weakness today. And when you add up to dollar weakness, when you add up Greek exit, and when there are just a rumor of that there might be some agreement between Eurozone leaders, then there is a jump in risk currency and safe haven currency go down. So basically, those kind of things you should always expect. And that is why I am favoring trailing stop usage. So be it trailing stop on break even or in a profit, but it's always best to secure your profits. Now the thing is, profit targets definitely are not the same for traders who trade harmonics, price action, chaos, range bars. Everything is different. With harmonic price action trading, we have potentially one target which we definitely want to trigger. When you're trading price action, news can basically whipsaw your chart, and then definitely trailing stop is the best method. Chaos charts are different. I'm not trading chaos, but money management is different. Range bars, totally different. Range bar tactics, usually you have predetermined set of range bars to get a profit after. So after 5, 6 consecutive bars you take profit, or after 3 consecutive bars you take, if the trade is not going in your favor, you take the loss. So every kind of trading dimension, every kind of trading system has its own rules. You just cannot say, well, I will make a 300 pip target and I will stick to it, because maybe your trade will go 100 pips in a profit and then it will go 100 pips in a loss. How can you know that? Because we are trading intraday, we need to know when is the right time to put our trailing stop. And that is one of the reasons why I know that there are a lot of trading systems out there and a lot of trading methods, but there is none that can. When I read it very frequently, and there is really not much information about when to use trailing stop, how to manage the trade, or if they give you information how to manage the trade, it is usually outdated. For example, some systems tell you to go with 2-to-1 risk ratio, and in today's circumstances, it's definitely not tradable. You can see what was happening with euro. Euro-dollar was 5 days in a range. The low was 20.69 and the height was, I don't know, 130.37, okay? And then euro-dollar was just, it was going like this. And most of the traders, I know that because I have read some reports, were inclined to the short side. For me, if you read my analysis and if you read my poll, I was definitely bullish on euro-dollar, and that is also a trade from our session recap. So you cannot be biased towards trading, especially if you trade intraday. But definitely it was hard to trade euro-dollar just saying, okay, I will enter at 120.80 and then I will leave the trade for 40.00. Some people can do that. I personally, I'm not doing that. When I saw that euro was going up, I was taking my profit, and I was basically all week long I was scalping euro. Every single dip which when euro dollar fell, I bought into, okay? And basically that was how I did my trade management. And I know that some traders said, okay, I agree with your analysis. I will make here an entry at 12.80 and I will put my stop loss, I don't know, at 12.50. And then I will wait, for example, 3 or 4 days to effectively get my trade in the profit. Sorry for this, I will turn down my phone. Okay, guys, I'm back. That was my phone ringing. Yeah, there was no sound. So definitely your mentor should tell you how to trade and where you should take profits. That is up to your mentor. That is up to you to basically know when to take the profit. Now we have the additional problem when we basically make a trade, and that is the pullback after the trade has gone in a profit, which may result in a break-even or stop loss being hit. Now, this is the biggest problem which I have identified so far in the trading. As Chris said previously, it's when you have a good method, it's pretty much easy to get a good entry. And that is what we are basically working on together. So we are usually having a great entries. But the thing is, the biggest problem for the trader who can experience, even during weekly trading, not just day trading, it where to take profit or when that pullback is going to happen, okay? And the thing is, that is why you should analyze a maximum adverse execution, so-called MAE, and maximum favorable execution, MFE, okay? So that you can work out precisely when an exit ceases to be effective. This is what I will be explaining you a little bit later. So, market is a fast and furious beast, so you need to be very careful. Very often you will see a big level being broken, just subsequently to be broken again, but in the opposite direction, and even candle making a new high. So that is why you should always stick to one particular trading system, and knowing when your trade is in the profit, what to do when your trade is in the profit. In the short run, you can definitely negate all of these obstacles by trading without stop loss. So now in the short run, trading without stop loss can be profitable because you won't have break-even trades, maybe big losers, but you will have a big drawdown. But in the long run, your account will be wiped. That is, now the traders who are not taking maximum adverse execution and maximum favorable execution are trading without stop loss. Now, it's obviously if you have 10,000, let's say, dollar account, and you want to trade with 0.1 lot, well, how many pips you should lose after you wipe up your account? You know, it won't happen so soon. But if you want to build up your account a little bit faster, and I know that most of us, let's say, if we start to trade with 10,000 or with 5, 7, 2,000, definitely it's in our interest to build up that account. Then definitely it's not manageable just to trade with leverage 0.3, 0.5, I know, without a stop loss, right? Because even if you use 0.5 trades on $10,000 account, 100 pip stop will definitely be if it's hit 5% of a loss. So I do not recommend doing that. Now you can do that. I definitely there is a possibility for you to do that. But you know, we talk about it trading versus gambling, and you can use Forex for gambling, right? So it's up to you. Maybe you will be lucky, and then you will build your account, and then you will start trading properly. I personally know that some traders, because I'm also one of founding members of a gambling forums. You can check it. It's gamblingforums.com. There are a huge number of gamblers who are trading professionally with big money, really big money. And many of those traders are very interested in Forex trading, of those gamblers. They're interested in Forex trading because they can put $5,100 on account and then gamble. It's not poker, it's not blackjack, but you can still gamble in Forex market without using stop loss, with using big leverage. You can double your account in a couple of days, but it's up to you. I am a trader, I am not a gambler, so I definitely I am supporting full-time trading. But if you have a lot of money to spare, and if you are not short on money, maybe you can try it. So there is usually 1 or 2, 3 good days when your account can grow 20, 30, 50%. But again, I'm saying I'm not supporting it. I'm not supporting it, but it is achievable. It is possible. Okay? It's up to you how you manage your trade and how you approach your trade. Okay? Now, because we are professionals and now we are talking about trading, not gambling, we assume that you will use and you have been using stop loss. So taking profits, depending that you are a professional trader or a normal trader, newbie trader, but with professional approach, taking profits is also dependent on time frames being traded and trailing stop placement. Okay? Now, scalping usually makes and some very fast pips, and that will definitely be something around 5 to 10 pips taking out of the market. Now, targets are determined by hourly pivot points as soon as the price makes 5 to 10 pips. Scalping is most suitable for gamblers because gamblers like fast profits, and also scalping is pretty much suitable to professional traders who want to build their account, because there is a difference between an already built account and the account who has been building up. Because if you have built up your account, you will definitely take a professional approach and trade, for example, each day or each second day, and then you will definitely be taking some money out of your account. then if you want to grow your account, then you definitely need to scalp, right? Because it's very hard to grow your account just by using, I don't know, waiting for a euro dollar to take off 100 pips in 7 days. It is achievable. It is achievable. But then you need to be ready to basically invest a lot of time and a lot of effort. Because only one single loss without a proper psychology entry, I can say, can kill all of your profits. That means that if you have been trading with 0.3, 0.5 pips lots, and you've been making some money, and you grow in your account for 20%, usually one single trade of a single lot with a 200 pip stop loss can kill all which you have built up for 5, 6, 7 months. That can be very annoying. So your psychology is also important. Gambling forums can be found at gamblingforum.com, and that is the forum where I also post. I will tell you now the address. Let me check it once more, and I will be giving you the address. So that is definitely, if you want to check how other gamblers, that is pretty much new approach, but it's gamblingforums.com. Yeah, so it's www.gamblingforums.com. Okay, so that is one of the important forums I am also in, because my job is always to approach professionally to Forex trading and to present our firm as one of big players in Forex market, and I want to educate all sort of traders and would-be traders how to approach professionally to trading Forex market. Even though if you have a lot of money to spare, let's say 100, 200, $500,000, you still need to know how to approach trading professionally. Okay? You can have a string of luck in 5, 6, 7 days, 1 month, but because you are not trading professionally, you will lose that string of luck and you will start losing your money. Okay? So you can always take a bigger risk, but only if you know what you are doing. And that is why I will also try to help those gamblers to have a peak in Forex market, to invest money, but invest it professionally. If they make money in gambling by making money on poker or blackjack, they should invest the money in Forex, because Forex is not gambling if you know how to trade it professionally. I always say Forex is about numbers, and Forex is about stacking odds to your favor. Okay? So, guys, I know that many of you, at least one of you, try to gamble at least once in their lives, so you know how it is. I know, personally, I know one of the best poker players in the world, and actually we have traded together back in time. So that is really, Forex trading is a great thing, but you need to know the proper approach. So that is about scalping. We already talked about this, so I will be fast with this. If you scalp on 1 minute to 5 minute trade, you will usually take 5 to 10 pips in a single trade. Okay? Scarp swings, that is my term which I use for M5, M15 trading, and usually targets are 10 to 25 pips. Scalp swings are something in between scalps and intraday trades. So if the method allows you to scalp with maximum 25 pip target, that is qualified as a scalp swing. Okay? Then intraday trading is usually done on 1 hour time frame, but some methods will allow it on M15. Okay? We use targets which are based on daily pivots, historical levels, Camarilla Marimet, and daily pivot points. Intra-week trading has bigger stops, one trade each week can be executed, and it's reserved for limited investors. Now everything, guys, which I have been talked about, including mid-long or term trading, is technical approach to trading. It's usually done on separate accounts. Targets are 300 to 1,500 pips. It's investing. Mid to long-term trading is called investing. Okay? And this is the table for optimum target zones. If you're scalping, you need to use strict target price. Now pay attention to the table. If you are scalping, you need to use strict target price. You definitely do not need to observe price action because scalping can be achieved with indicators. You don't use trailing stop unless you are making a scalp into a scalp swing and scalp swing into an intraday trade. If you remember the webinar, how to turn scalp into scalp swing and scalp swing into intraday trade, you know what I'm talking about. When you're scalping, you can take profit by heart. So basically, it can be allowed for scalping. When you make scalp swings, you also need to respect your target. You should observe price action because sometimes scalp swings can be turned into intraday trades. Now I don't have the time to again explain how to turn scalps into scalp swings into intraday trades, but that webinar we already covered, so please refer to the webinar. You don't use trailing stop on scalp swings usually, and sometimes it's okay to take profit by heart. When you do intraday positioning, you should not have a strict target. You should have a defined target, but not a strict target. Because sometimes, as I already said, if you go 25, 30 pips in profit and you do not manage your trade, that trade can be a loser. You should definitely observe price action, okay? You should definitely observe price action, okay? You should use trailing stop, and you do not take profit by heart, okay? And intra-week trading, you do not use strict target price, you should not observe price action, you should use trailing stop, and you do not take profit by heart, okay? Table is not entirely in this slide. Let me check. Now you will see the table fully, okay? Let me show you the slide again. Okay, now you can see the table, right? It's in the slide. Table is, yeah, great. So again, this is a table which you should take a snapshot. Strict target price for scalping allowed. Observing price action, not allowed when you scalp because you take 5 to 10 pips profit. Trailing stop, no, without. And TP by heart, yes. Now, obviously, this is for traders who do not know how to turn scalp into scalp swing into intraday positioning. For you who know how to do that, you can use trailing stop even when you scalp. Okay? Scalp swings, you should definitely use strict target. Sometimes you should observe price action, especially around the news time if you have your trade opened. You do not use trailing stop unless you want to turn a scalp swing into intraday position. And for intraday trades, trailing stop is very, very favorable. Okay? So, what about trailing stop? Markets are volatile and advise using trailing stops. Trailing stop should definitely be applied anywhere from intraday up. So, intra-week and intra-month positions. Trailing stop is an effective way to secure profits in volatile markets. Now, pay attention. Although it can lower risk to reward, if you have a method which is 70 to 80% successful, you can do it safely after 12 to 15 pips of profit if stop loss does not exceed 32 pips. Because even though if your reward to risk is not that big, if you have a method which is 70 to 80% successful, with using trailing stop, you definitely can make money. The optimum target price is solely dependent on the method you trade and what your mentor told you to do, unless you're observing price action, okay, with a gut feeling or discretionary method. Now we have also additional approaches, which I definitely recommend you to learn a lot about this, and I will recommend you a book which you should read for this, okay? It's called Maximum Adverse Execution, MAE and MFE, Maximum Favorable Execution. Predefined ASICs at pivot levels. Now, obviously, when we talk about predefined ASICs, I will move on to these two very important things after I finish with this. So predefined ASICs, guys, the most popular way traders exit the trades just involves simply thinking of an arbitrary number of pips or a dollar value and then closing the trade when it hits that level. It makes risk management easier, but it doesn't have much logic to it other than it's actually a lazy way to approach. Now, of course, you cannot be always able to predict the market turn exactly, but it's better always to have a solid understanding of your exits, okay? So the real exit, if you use predefined exit, should come from your trading strategy logic, okay? Pivot levels, now obviously most of the trading systems are pretty much dependent on pivot point and pivot levels, and on short-term horizons, pivot levels tend to be great places to exit trades. Many professional day traders use pivot levels. They are also useful to stops. So pivot levels are a great approach for exiting your trade, okay? But definitely most of those pivot levels are very close by, so sometimes you can see that the distance between S1 to S2 or R1 to R2 is not that big. Again, it's up to your system, but it can be good. Now the thing is, what you should do, and you should invest a lot in thought into, is MAE or Maximum Adverse Excursion. I can say, for example, for starters, that if you look at two factors, MAE and MFE, you can work out precisely when an exit ceases to be effective. MAE stands for the maximum loss of a trade after entry. So that if you use MAE analysis, it can reveal that your trades never make any money, let's say once they have dropped by 15 pips. So you can place your stop 15 pips away and be safe in the knowledge that you have a good stop in place, okay? So if you're long, then it is the lowest low after your entry bar. So maximum adverse excursion is the maximum loss of a trade after the entry. So if you're long here and the trade goes 20 pip in a drawdown and then goes in a profit, that is the lowest low after your entry bar, and your maximum adverse excursion will be those 20 pips which the trade initially went in a drawdown. If you're short, then it is definitely a highest high after your entry bar, okay? And this shows it perfectly. You can use myfxbook.com. You can log into myfxbook and then basically analyze your MAE and MFE, okay? So this is how it shows for long trades and short trades. And by looking at this example, MAE for this account, because this is obviously intra-week account, the maximum drawdown was almost 300 pips, then 200 pips, and it was a way better for long trades than for short trades. Now, if a trader knows the MAE for most of their winning trades, then you can use that knowledge to trade the system with even better risk-to-reward ratio. So, for example, if you find out that most of your winning trades do not go against you by more than 20 pips, then you use that knowledge to cut your losses when they are more than 20 points. Do you understand what I'm implying? You should definitely pay attention to maximum adverse excursion. That can also bring you to a higher profit level, because then you can, instead of using 0.3, you can use 0.5. Analyze your trades, okay? This is very important knowledge, guys. I don't know if you have already known about this, but if you haven't, then please learn it, analyze your trades. Okay? Why would you put a stop loss of 45 pips if you find out that your trades do not go against you by more than 20 pips? I know on my Camarilla MACD, that is why I usually recommend 30 pips plus spread. Or if I do intra-week analysis, as I do on weekly recaps, it can be sometimes 50. But it's very rarely above 50 because it depends whether we are trading on intraday or intra-week basis. What is MFE? It's maximum favorable excursion. MFE is basically telling you, okay, that your trades, let's say, can rarely make money once they have hit 50 pips of profit. Okay? So if your trades are making 30 pips of profit, averagely by MFE analysis, you will usually take those 30 pips and you will not risk a loss because you want 50 pips. So MFE is the maximum profit that the trade had experienced before it was closed. Pay attention to this. Because if you do that, it will be easier for you to identify better targets. It will measure how much a trade moves in your favor from your entry. Okay? So it will definitely measure how much a trade moves in your favor from your entry. So if most of your trades are making after your entry 30 pips, then you will not wait for 100 pips. You will wait around 30 pips, and if the trade goes at 35 pips of profit, you will move your stops to break even plus 30. Okay, now you understand what I'm saying, what I'm implying, guys. Use this knowledge. Once more, analyze your trades. You should invest your time into doing that. And if you find out that most of your trades are moving 30 pip in a profit before they go down, then after your trade moves 35 pips in a profit, you should put your stop loss to break even plus 30 and secure those 30 pips and use the trailing stop after it moves 40, 50 pips in a profit. The objective of the MFE strategy is also to add to position during trades that offer greater than normal profit potential. And for all of you who are interested to delve deeply into these two approaches, read the book. It's called Maximum Adverse Excursion, Analyzing Price Fluctuation for Trading Management by John Sweeney. It's a good book, 1997 I think it was published, and you can find it on the internet. You can at least buy it from Amazon. It's a good book. Read it. Okay, I strongly recommend you this book. And then you can log into myfxbook.com and analyze your trades. You can definitely analyze MFE and MAE on myfx.com. So for a proper analysis, if you want to use MAE and MFE analysis, you should analyze MAE versus trade outcome in pips, MAE versus trade outcome in gain, MAE versus trade outcome in profit, MAE versus MFE, winners versus losers in pips, MAE versus MFE, winners versus losers in gain, and MAE versus MFE, winners versus losers in profit. It's a game of numbers. Forex is a game of numbers. Okay? Analyze your trades, analyze your system. Or if you use two different systems, one for scalping, one for intraday, or maybe three different, one for intra-week, then analyze all of this to help you to find and optimize your exits way better than you do it at the moment. This is one of my accounts, which I also have, and by analyzing this account, I have come to a conclusion that I can definitely experience 10 pips of the maximal drawdown, but I'm not trading each single day with this account. This is not a day trading account. This is the account where I make trades once per week. And by analyzing this, I can definitely see that my method for intra-week trading, or let's say it's not intra-week, more or less those are the trades which I give you on weekly Forex recap plus some of the scalps. And look at this, 70% of profitable trades. Okay? So I know that my method is 70% successful. Okay? It's 23%. 23% up. Okay? This is where I made a deposit and I went in a drawdown, but that drawdown is reflected this. And this is now the profit. But I'm not trading each single day. This is more of a Camarilla MACD weekly recaps plus some scalps. Okay, but it's good. I cannot say it's not good. Because 70% of the trades are in the profit. Okay? And the strategy is not risky. Okay? By analyzing this and MAE, MFE, I have come to a conclusion that most of my trades are good if I don't use more than 30 pips plus spread stop loss. Okay? You should do this. And on last thing which I want to show you, and we are already over the time, this is, if you read my analysis of Australian dollar today, I have published it on the blog on Forex Factory and on Admiral Markets main website. Guys, you know, I had many questions concerning Australian dollar trade, but this is what we could do it if we basically traded with a trailing stop today. This was first POC when the price got in, and not if I don't include this point here, we can have even at this point 30 pips, then another 30 pips in a profit. And now, what would a wise trader say? If I draw a trend line over here, I can see, let's make it like this. You should always, guys, pay attention to the trades which you're trading. If you draw a trend line over there, and you can see that there was one rejection which gave us a profit after 20, 30 pips, and another rejection that gave us profit. Now you can see it's double bottom here, and the pair cannot go down. You just do not leave the trade for this profit zone, because there is a chance that the trade will come to POC2. And what happened is it came to POC2, to the pip. Look at this. You can check it. I already posted this before it happened, and this is result after the analysis, after the trade has happened. You can definitely see that after POC2, the price had not a lot power to break through POC1, and then you could at least grab 15, 10 pips or be stopped at break even. Because after this has happened, the price shooted up. That is why you should pay attention to the trades, to the pairs you are trading. First trade, 30 pip potential. Second trade, 30 pip potential. Double bottom, we are out of the trade. POC2 is hit. 22 pips, but hammer here. It doesn't go in our favor. Put your stop loss to break even. Okay? That is how you should approach your trade. And always pay attention to MAE and MFE. Maximum risk excursion and maximum favorable excursion. Okay? Read this book. It will help you. So guys, this is everything me and Chris had for you today. So we are already over the time. I hope that you enjoyed. And definitely, Loy saying thank you for a great webinar. Guys, thank you all. Thank you. And do not forget to sign up for next set of webinars. Of course, live trading room with Chris, and definitely Forex recap sessions on Monday, because I expect next week to be also very successful. And always, 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 when you open a trade, and it's an intraday trade or scalp trade, do not leave it like that. Pay attention to these levels. Pay attention to the zones. Because if you use this knowledge and you make a few simple technical steps, your trade will be in profit, or you at least will not be stopped out. So thank you once again. We will talk with you soon. At the moment, we wish you to trade safe and to trade with a low risk, because you want to be a long-term Forex trader, not just a runner-up. Thank you, and talk to you soon.